Welcome to our deep dive into the impact of innovation within strategic management. Today, we'll explore how innovation shapes business strategies, drives growth, and creates competitive advantages. Understanding this relationship is crucial for organizations aiming to thrive in dynamic markets. Throughout this video, we'll break down key concepts, real-world examples, and practical frameworks to help you assess innovation's true value. Let's begin by defining what innovation means in a strategic context and why it matters for long-term success. Innovation isn't just about new products or flashy technology. In strategic management, it refers to the process of creating value by applying novel ideas, processes, or business models. This could mean improving existing operations, launching disruptive services, or rethinking how a company delivers value to its customers. By understanding innovation in this broader sense, organizations can identify more opportunities to differentiate themselves and stay ahead of competitors. Strategic management is all about setting long-term goals, analyzing competitive environments, and allocating resources efficiently. It's a continuous process that requires organizations to adapt and evolve. Innovation plays a central role here, as it can redefine industry standards and open up new markets. By integrating innovation in strategic planning, companies can better anticipate changes and respond proactively. Assessing the impact of innovation is essential for measuring its effectiveness and aligning it with business objectives. Without proper assessment, organizations risk investing in projects that don't deliver value or support strategic goals. By evaluating innovation outcomes, leaders can make informed decisions, allocate resources wisely, and ensure that innovation efforts contribute to sustainable growth. Innovation comes in many forms. There's product innovation, which focuses on new or improved goods and services. Process innovation aims to enhance how things are done, making operations more efficient. Business model innovation reimagines how value is delivered and captured. Each type has unique implications for strategy and requires different assessment approaches. Consider a tech company launching a groundbreaking smartphone. This product innovation can disrupt the market, attract new customers, and boost brand reputation. However, its true impact depends on how well it aligns with the company's strategic goals and whether it creates sustainable competitive advantages. Assessing this requires both quantitative and qualitative measures. Imagine a manufacturing firm adopting automation to streamline production. This process innovation can reduce costs, improve quality, and increase flexibility. To assess its impact, managers should track metrics like efficiency gains, cost savings, and employee satisfaction. The strategic value lies in how these improvements support broader business objectives. Classic example of business model innovation is the shift from selling products to offering subscription services. This approach can generate recurring revenue and deepen customer relationships. Assessing its impact involves analyzing customer retention rates, lifetime value, and market share growth. The strategic implications are significant, often requiring changes across the organization. Innovation is a powerful driver of competitive advantage. By introducing unique products, services, or processes, companies can differentiate themselves and capture market share. However, sustaining this advantage requires ongoing investment and adaptation. Assessing the impact of innovation helps organizations understand what's working and where to focus future efforts. Several frameworks can guide the assessment of innovation impact. Balanced Scorecard, for example, links innovation initiatives to key performance indicators across financial, customer, internal process, and learning perspectives. Other models, like the innovation value chain, map out how ideas are generated, developed, and implemented. Choosing the right framework depends on your organization's goals and context. Balanced Scorecard is a strategic management tool that helps organizations translate vision into action. It encourages leaders to measure innovation's impact not just financially, but also in terms of customer satisfaction, internal processes, and learning and growth. This holistic approach ensures that innovation supports overall strategy and delivers value across the business. Innovation Value Chain Framework breaks down innovation into three main stages: idea generation, idea conversion, and idea diffusion. By assessing each stage, organizations can identify bottlenecks and opportunities for improvement. This approach helps ensure that innovative ideas don't just stay on paper, but are actually implemented and deliver measurable results. Quantitative metrics are essential for objectively measuring innovation impact. Common indicators include revenue growth, market share, cost savings, and return on investment. By tracking these numbers over time, organizations can determine whether their innovation initiatives are delivering tangible business results and supporting strategic objectives. Not all innovation outcomes can be captured by numbers. Qualitative metrics such as customer feedback, employee engagement, and brand reputation provide valuable insights into the broader impact of innovation. These measures help organizations understand how innovation is perceived and whether it's driving positive change internally and externally. Assessing innovation impact requires a balance between short-term and long-term perspectives. Some innovations deliver immediate results like cost reductions or quick sales boosts. Others, such as cultural shifts or new business models, take time to show their full value. Strategic management involves weighing both types of impact to make informed decisions. Managing a portfolio of innovation projects helps organizations diversify risk and maximize returns. By assessing the impact of each project, leaders can prioritize investments and ensure a balanced mix of incremental and breakthrough innovations. This approach supports strategic agility and long-term growth. Leadership plays a critical role in fostering a culture of innovation and ensuring its alignment with strategy. Leaders set the vision, allocate resources, and create an environment where new ideas can flourish. Assessing innovation impact often starts at the top, with executives championing change and modeling innovative behaviors. Supportive organizational culture is essential for successful innovation. Companies that encourage experimentation, tolerate failure, and reward creativity are more likely to generate impactful innovations. Assessing the cultural impact of innovation initiatives helps leaders identify strengths and areas for improvement. Employees are often the source of the best innovative ideas. Engaging staff in the innovation process increases buy-in and leverages diverse perspectives. Assessing the impact of employee involvement can reveal how well innovation is integrated into daily operations and whether it's driving meaningful change. Innovation should always be guided by customer needs and preferences. By involving customers in the innovation process, companies can ensure that new products and services deliver real value. Assessing customer satisfaction and adoption rates provides direct feedback on the impact of innovation efforts. Assessing the market impact of innovation involves tracking changes in market share, customer segments, and competitive positioning. This analysis helps organizations understand how their innovations are influencing the broader industry landscape and whether they're gaining a strategic edge. Financial metrics are a key part of innovation assessment. Tracking revenue growth, profit margins, and return on investment helps organizations determine whether innovation initiatives are delivering the expected financial benefits. This data supports strategic decision-making and resource allocation. Innovation always involves some level of risk. Assessing these risks, such as market uncertainty, technological feasibility, and resource constraints, helps organizations prepare for potential challenges. A thorough risk assessment ensures that innovation efforts are both ambitious and realistic. Not every innovation will succeed, but failures can provide valuable lessons. By systematically assessing failed initiatives, organizations can identify what went wrong and apply these insights to future projects. This learning mindset is essential for continuous improvement and long-term success. Benchmarking involves comparing your innovation performance with industry peers or best-in-class organizations. This process helps identify gaps, set realistic targets, and adopt proven practices. Regular benchmarking ensures that your innovation strategy remains competitive and aligned with market trends. Innovation doesn't happen in isolation. Companies often collaborate with partners, suppliers, and even competitors to drive innovation. Assessing the impact of these ecosystems involves looking at shared value creation, knowledge exchange, and joint ventures. A strong ecosystem can amplify the impact of individual innovations. Technology is often at the heart of innovation. Assessing the impact of new technologies involves evaluating their adoption rates, integration challenges, and contribution to strategic goals. This assessment helps organizations stay ahead of technological trends and make informed investment decisions. Sustainable innovation focuses on creating value while minimizing environmental and social impacts. Assessing sustainability involves tracking resource efficiency, carbon footprint, and social responsibility. Integrating sustainability into innovation strategy can enhance reputation and open up new market opportunities. Digital transformation is a major driver of innovation in today's business world. Assessing its impact involves measuring improvements in efficiency, customer experience, and data-driven decision-making. Successful digital transformation aligns technology investments with strategic objectives and delivers measurable business value. Open innovation involves leveraging external ideas and resources to accelerate internal innovation. Assessing its impact requires tracking partnerships, co-development projects, and the flow of knowledge across organizational boundaries. This approach can expand innovation capacity and speed up time to market. Innovation often requires significant organizational change. Assessing the impact of change management efforts such as training, communication, and stakeholder engagement helps ensure that innovation initiatives are successfully adopted and sustained over time. Speed is a critical factor in innovation success. Assessing how quickly new ideas move from concept to market can reveal bottlenecks and opportunities for acceleration. Faster innovation cycles often lead to greater competitive advantage and improved responsiveness to market changes. Protecting intellectual property (IP) is vital for sustaining innovation-driven advantages. Assessing the impact of IP involves tracking patents, trademarks, and copyrights, as well as their contribution to competitive positioning. Effective IP management supports long-term strategic goals. Scaling successful innovations across the organization amplifies their impact. Assessment focuses on adoption rates, standardization, and the ability to replicate success in different contexts. Strategic management ensures that scaling efforts align with overall business goals and capabilities. Metrics dashboard provides a real-time view of innovation performance. By consolidating key indicators such as project progress, financial returns, and customer feedback, leaders can quickly assess impact and make data-driven decisions. Dashboards support transparency and accountability across the organization. Apple is renowned for its innovative products and business models. By consistently assessing the impact of its innovations, such as the iPhone and App Store, Apple has maintained a strong competitive position. The company's strategic management practices ensure that innovation remains at the core of its success. Tesla's approach to innovation has disrupted the automotive and energy industries. By assessing the impact of its electric vehicles and energy solutions, Tesla continues to push the boundaries of what's possible. Strategic management enables the company to scale innovations and maintain its leadership position. Amazon's relentless focus on innovation has transformed retail, logistics, and cloud computing. By systematically assessing the impact of new services and technologies, Amazon ensures that innovation drives growth and customer satisfaction. The company's strategic management processes support continuous experimentation and improvement. Assessing innovation impact isn't always easy. Common barriers include lack of data, unclear objectives, and resistance to change. Overcoming these challenges requires strong leadership, clear communication, and a commitment to continuous learning and improvement. Maximize the value of innovation assessment. Organizations should set clear goals, use a mix of quantitative and qualitative metrics, and regularly review progress. Involving stakeholders at all levels ensures buy-in and alignment with strategic objectives. Best practices also include benchmarking and learning from both successes and failures. Innovation assessment should be an ongoing process, not a one-time event. By continuously monitoring and refining innovation efforts, organizations can adapt to changing environments and seize new opportunities. This approach supports long-term strategic success and resilience. The most impactful innovations are those that align closely with organizational strategy. By ensuring that innovation initiatives support core business objectives, companies can maximize their return on investment and drive sustainable growth. Assessment plays a key role in maintaining this alignment. As technology and markets evolve, so do the methods for assessing innovation impact. Emerging trends include the use of artificial intelligence, big data analytics, and real-time dashboards. Staying ahead of these trends ensures that organizations can continue to measure and maximize the value of their innovation efforts. We've covered the essentials of assessing innovation impact in strategic management, from defining innovation and its types to exploring frameworks, metrics, and real-world examples. Remember, effective assessment is about more than just numbers. It's about understanding how innovation drives value and supports long-term strategy. Thank you for joining us on this journey through innovation impact assessment. As you move forward, consider how your organization can apply these insights to strengthen its strategic management practices. By continuously assessing and refining innovation efforts, you'll be well positioned to achieve lasting success in an ever-changing business landscape.